Murray Goulburn is a cooperative formed of dairy farmers who has grown to become Australia's largest milk processor. They have a portfolio of dairy products which are sold domestically and overseas, including many well-known brands such as Devondale and Liddell's. It has a complicated ownership structure, whereby it undertook a partial float in 2015, which restricted any one entity from owning more than 0.5% of issued shares without 90% approval from the farmers, making a takeover bid increasingly complex. The context of this bid flows on from a period of poor financial management of the cooperative. Business had pursued an aggressive expansion strategy, leaving them with extreme levels of debt and vulnerable to falling milk prices. They were in dire need of substantial capital injection to keep the business viable as competitors encroached on their market share. Therefore, in 2017, they undertook a comprehensive strategic review. They concluded a whole business acquisition was their best option. Therefore, Murray Goulburn is the target in this takeover. As aforementioned, Murray Goulburn had a complicated capital structure. They had a special purpose funding vehicle known as the MG Unit Trust, which was listed on the ASX. Investors in the trust were unit holders, therefore their exposure was purely economic. They had no voting rights. The funds raised by the trust was invested in Murray Goulburn Co. through financial notes. Murray Goulburn engaged with 30 parties regarding a potential deal. However, of that 30, only 3 ended up in the final stages of negotiation. These parties were homegrown company Bega Cheese, French company Parmalat, and Canadian-based business Saputo. From this, the successful bidder was Saputo. They're a Montreal-based dairy company listed on the Toronto Stock Exchange. Saputo has subsidiaries globally, including the US, UK, Argentina, and a strong foothold in Australia. Their deal with Murray Goulburn follows on from their recent $393 million acquisition of Warrnambool Cheese and Butter, which was finalised in early 2017. Finally, the ACCC and Foreign Investment Review Board are also relevant parties, as the deal was made subject to approval by both of these regulatory boards. So on October 27, 2017, Murray Goulburn and Saputo entered into a conditional off-market sale and purchase agreement for the sale of Murray Goulburn assets. The deal was structured as an asset sale rather than a share takeover. A key rationale of this was that Murray Goulburn was facing a class action suit regarding contraventions of the Corporations Act and breaches of fiduciary duties. Thus, the asset sale allowed Saputo to assume the operating assets and liabilities of Murray Goulburn, whilst excluding liabilities such as those related to the litigation. The bid agreement was underpinned by 5 key terms. Firstly, termination of the sale and purchase agreement. Murray Goulburn and Saputo were entitled to terminate the deal if the opposite party, or one of their subsidiaries, became insolvent. Similarly, if the opposite party breached a warranty given, which would prevent them from moving forward with the transaction. Further, both parties were allowed to terminate if Murray Goulburn's board publicly withdrew its support for the bid or recommended a competing proposal. And finally, they could terminate if one of the other key terms of the bid was not satisfied. Next, we'll look at consideration. Saputo offered cash consideration for the assets and liabilities, which was agreed to be $1.31 billion. However, the price was subject to changes in the working capital of Murray Goulburn. If the working capital increased or decreased from the base value, the purchase price would be adjusted. Additionally, any amounts still owing to Murray Goulburn suppliers at the transaction date would be deducted from the purchase price. One of the most important terms to the Murray Goulburn board was the milk supply commitments. Saputo agreed to step up the price paid for milk solids by 40 cents per kilo to qualifying Murray Goulburn suppliers. Additionally, they committed to purchasing milk from current Murray Goulburn suppliers for a 5-year period, provided the terms are no less favourable than those extended to Murray Goulburn. This was a key piece to the deal, as it is what encouraged many of the shareholders, who were all dairy farmers, to approve the transaction. There were 3 exclusivity terms in the agreement. There was a no-shop condition, whereby Murray Goulburn could not directly or indirectly solicit expressions of interest, offers, or proposals from third parties which could result in a competing bid. There was a no-talk condition, where Murray Goulburn could not engage in any discussions or negotiations with third parties in relation to a competing proposal. However, Murray Goulburn did have a fiduciary out, which we'll discuss later in our presentation. Finally, a matching right. If Murray Goulburn did receive a competing bid, they had to provide Saputo with all material terms and give them 5 business days to match the proposal before entering into a binding agreement. And then the final term of the agreement was the reimbursement fee. If Murray Goulburn chose to accept a competing bid, or if they were responsible for terminating the bid, they were required to pay Saputo $13.1 million.